When geopolitical risks rise, many commodity markets are impacted. How and why are recent tensions in the Middle East relevant for commodities is something we will talk about in this episode. But first, we will talk about platinum. With us today is Edward Sterck, Director of Research at the World Platinum Investment Council, and we'll talk all about both the cyclical and the structural stories behind this very dynamic precious metal. Welcome to the Commodity Exchange, a podcast where we bring you insights from the world of commodities. Whether you are an investor or just want to learn more about the topic, this podcast is for you. I'm Mobeen, Director of Macroeconomics and Thematic Research at WisdomTree.
And I'm Nitesh Shah, Head of Commodities and Macroeconomic Research here at WisdomTree.
Before we begin, I do need to state the following. To clarify, the views and opinions expressed in this podcast are those of WisdomTree and in this episode, the World Platinum Investment Council, and are subject to change. Anything we present in this podcast is not intended to be relied upon as a forecast, research, nor as investment or tax advice. The information and opinions expressed in this podcast are not a recommendation, offer, or solicitation to buy or sell any securities, and reliance upon them is at the sole discretion of the listener. Please remember, past performance is no indication of future results. With that, over to you, Nitesh, to kick us off on the platinum discussion.
Well, Edward, thank you so much for joining us today. Why don't you tell our audience a little bit about yourself and the World Platinum Investment Council? What do you do as an organization, and how do you work within the platinum ecosystem?
No, Nitesh, thanks very much indeed for having me on. It's a privilege. So the World Platinum Investment Council was set up about 10 years ago by our current shareholders, which are the major platinum producers in South Africa. Our mandate is to increase investment in platinum, and we do that, broadly speaking, in two ways. So firstly, we partner with various different mints and refineries, bullion dealers and so on around the world, and we just try and help them produce and sell platinum product. We do that in a couple of ways, so some of which is sales force education, but also we provide some research and product that they can use for their clients. The other side of the organisation, which is where I sit, I'm the Director of Research at the World Platinum Investment Council, is more institutionally oriented. So we produce free research that's all available on our website, oriented towards more institutional type investors, and effectively we think that the metal is relatively poorly covered by sell-side research, and we're in effect trying to increase information liquidity. So we provide this research. We go around and meet with pension funds, hedge funds, and the like around the world, and give them insights into the platinum markets and palladium as well, and just hopefully give them enough confidence that they are in a good position to be able to make a decision as to whether to invest in platinum or not. The ultimate and lofty goal is to make it a question of not should I or should I not own platinum right now, but how much platinum should I own? But that is maybe a bit of a stretch target. That's ultimately what we try to achieve.
That's excellent. And I do recommend our audience to visit your website and read some of the excellent research that you put out. And speaking of some of your excellent research, you've just published your quarterly platinum piece in which you describe 2023 as having been a record year in terms of deficits for platinum. That's absolutely amazing. Tell us a little bit more about what's driving that deficit in the metal.
Absolutely. So just for context, because we are owned by the South African platinum mining companies, we are rather tightly bound by antitrust legislation. And so we can't talk we don't put out any price forecasts. We can't talk to price, we don't forecast prices. And anything that's 1 year forward or less, which could be indicative of a view of different price directions, has to be produced for us on an independent third-party basis. So we use a group called Metals Focus to do that at the moment. So the record deficit for 2023 is a Metals Focus estimate, not ours. Now, that's obviously on a backward-looking basis, but it's effectively the underlying reasons behind the deficit were some production challenges. So mine supply is looking quite constrained. It continues to look constrained through this year and going forwards. And then also there are a lot of headwinds facing the recycling industry. So in platinum terms, platinum recycling has declined by about 500,000 ounces, so from 2 to 1.5 million ounces over the period 2021 through to 2023. And that's due to a number of factors that we can unpack in more detail, but in summary, a shortage of end-of-life vehicles, and then regulatory limitations in the US and in China in particular. So that's on the supply side. On the demand side, feeding into that record deficit, we had a record year in terms of industrial demand. So industrial demand was up substantially year on year, driven by increased installations in the glass and chemical subsectors, and that was also bolstered by positive investment demand on balance for the year as a whole. So strong industrial demand and okay investment demand, and then also some relatively robust automotive demand as well. So automotive demand, platinum is used in the catalytic converters or in the exhaust treatment systems in internal combustion engine vehicles. You can kind of swap platinum for palladium in gasoline vehicles at least relatively easily. And what we've seen is, given that palladium's been trading at a significant premium to platinum for the last few years, automakers have been preferentially choosing to use more platinum and less palladium, and that's helping to support that automotive demand for platinum. So all of those factors together combine to make that record deficit that we saw last year.
Edward, if we explore your point about supply challenges a little bit further, you mentioned that supply has been challenged for various reasons. We know that among the most important producers of platinum are South Africa, and where electricity shortages have hampered production. And of course, Russia is another important producer, which has been subjected to sanctions in various commodity markets. Give us your overview of how you see the supply situation evolving and what lies ahead in terms of platinum supply and some of those challenges that you alluded to earlier.
So in terms of the outlook, and I'm going to chicken out a bit here, because we're owned by, we're talking about our shareholders' own plans in terms of their mined production expectations. We just use the aggregated midpoint of company guidance. That said, I can talk to some of the challenges and the risks that they are having to kind of navigate. So in terms of South Africa, you mentioned the electricity supply shortages. That was quite a big factor that played into 2022 and also 2023 in terms of limiting or making it difficult to continue, to operate at planned capacity rates in South Africa. I think the miners as a whole actually did a pretty good job of managing that electricity supply shortage. And looking as things stand at the moment, we've seen those shortages ease quite significantly. So Eskom, which is the state utility in South Africa, has kind of managed to increase its generating capacity, or at least its power to the grid, and added to which that's being assisted by private enterprise in terms of people building their own power generation, so solar panels and wind turbines and things like that. And all of the mining companies have plans to install significant amounts of renewable energy generation capacity over the next couple of years, just to give themselves better protection against the potential for Eskom to continue to underperform expectations. In terms of the outlook, I think they've all announced some pretty significant restructuring plans in South Africa. So the real challenge has actually been more in terms of the fall in the price of palladium and the fall in the price of rhodium. So all of the platinum group metals are produced from the same ore bodies. And when you aggregate all of the metals that are within those ore bodies and look at the value of those metals, that creates something called the basket price. Now, the basket price declined by around 45% over the course of 2023, and that pushed the effective price well down into the cost curve. So around 35% of South African platinum mining output in 2023 was effectively loss-making, which is quite a big number. Now, they have had some tailwinds in terms of the rand weakening. So whilst officially it might be loss-making, they're relatively marginal. But in order to give themselves better protection, they've announced some pretty significant restructuring in terms of employment, so quite a lot of job losses. And the longer-term outcome from that is probably going to be reduced production flexibility and effectively a higher risk being overlaid onto the ability for these companies to meet their production plans. They haven't really changed medium to longer term guidance despite the job losses. So they were still expecting to achieve them, but the risk to being able to deliver to those plans goes up. In terms of Russia, Russia's obviously very interesting at the moment for topical reasons, as you mentioned, the sanctions. I think the near-term impact of the sanctions is probably fairly limited in terms of platinum and palladium supply. And I say that because platinum and palladium were already sanctioned by the London Platinum and Palladium market and also the market in Switzerland back in April 2022. So effectively, Russian origin PGMs were no longer good delivery on the LPPM, London Platinum and Palladium market. And yet we've continued to see Russian material flow through out of Russia to users in other countries. And the reason being that even if it's not good delivery, if you're an industrial or an automotive end user of those PGMs, you don't have to trade it through the LPPM. You can still buy it and stick it on a Ford F-150 in the US without having broken any sanctions or anything like that. I think the bigger impact of the sanctions, and obviously it's the base metals that are being sanctioned now, is that it probably eliminates the growth plans that Nornickel had in place, which is the major PGM producer in South Africa, that they had in place prior to the invasion of Ukraine. So effectively, flat will be the new up for Russian output. And if anything, the risks are probably to the downside. So what has been sanctioned for a few years now has been the flow of Western origin mining equipment into Russia. Now, they can probably smuggle spares for things like their mine fleet and drilling equipment and things like that, or they can pivot to China and get the Chinese equivalent. The problem for them is going to be in the large capital items. So it's things like your plant, the processing equipment in your plant, so things like ball mills and the drives for those mills. If they break down, you can't get an engineer to come in from Germany to come and fix it. You can't get the spares for it. And you can't pivot to China to go and get the alternative because a ball mill is a long lead time capital item. So I think the risk to Russian supply to the market is we see these large capital items begin to fail, and it just gradually erodes the output from Russia, which just reduces supply over the medium to long term.
Wow, that's fascinating. Thanks for providing all those clarifications. Now, you also mentioned that the automotive sector is the largest sector in terms of demand for platinum group metals, platinum included. And tell us a little bit about some of the developments there. You mentioned that platinum is taking a greater share from palladium as the price differential has generated an opportunity for substitution. But tell us a little bit more about some of the general trends you're seeing in the automotive sector, and whether that general movement away from internal combustion engine vehicles towards electric vehicles, whether that's likely to continue or whether we're going to start seeing some slowdown in that trend.
So I think electrification of the drivetrain is something that will continue. And the question is probably, as you touched on in your last comment there, it's the pace of that electrification that's the kind of big question mark. So if we use 2030 as a kind of basis line to talk to, a couple of years ago, if you were talking to an analyst that covered the automotive sector, they'd probably have said, 2030, we're going to see something like 60% battery electric vehicle market share. Our numbers 2 years ago were much lower than that. They were below 40%. But generally what we're seeing is the early adopters of battery electric vehicles have adopted. They've made the switch, and they did it with some pretty significant government subsidies and tax sort of stimuli. And those have gradually faded away. And yet the next cohort of consumers who are incrementally more skeptical of battery electrification they're the ones that need to switch next, but without all of those subsidies and that state support. So what we're seeing is there's a kind of rolling over in terms of market share. And really, if you look at China, things are sort of plateauing in the 20 to 25% area. In Europe, it's sort of 12 to 15%, and in North America, it's not a big V8 battery electric vehicle, so it's not as popular in the States, but it's kind of around 7% is the level that battery electric vehicles seem to be sort of plateauing at. So that consumer reluctance is a real challenge for the automakers, because they've still got to meet the fleet-wide CO2 reduction targets that have been enacted upon them by by the regulators. So I think the outcome from that is ultimately going to be hybrid vehicles, and hybrid vehicles typically have 10 to 15% higher PGM loadings than the alternative, the internal combustion engine equivalent. And the reason being that the engines are turned on and off more frequently, so they're typically operating at a lower temperature, which means the exhaust treatment system is cooler. And to compensate for that, you need more PGMs in order to meet your emissions targets. So those hybrid vehicles allow the automakers to meet their CO2 reduction targets, but are also incrementally positive in terms of fewer BEVs, more ICE, and therefore more demand for platinum, palladium, and rhodium as well. So all of the PGMs. Interestingly, one of the fastest growing hybrid technologies, which we're seeing go up significantly in China in particular, is extended range electric vehicles. So these are battery electric vehicles, but with a gasoline engine kind of bolted onto them as a generator. Some of these vehicles can do over 1,000 kilometers of range effectively. So the battery plus the motor acting to charge the battery when the battery is running out of juice. My assumption on these previously had been that these internal combustion engines were pretty small, but actually we started doing some research last week and have established that they're pretty significant. So they're typically 1.5 to 2 litre turbo engines, which is actually quite sizable. And the current guidance from the regulators are that the PGM loadings in the exhaust treatment systems are actually broadly comparable to the straight ICE equivalent. So if you had a 2 litre or 1.5 or 2 litre turbo vehicle, the amount of PGMs in the exhaust treatment system is the same as is going into these extended range electric vehicles. The numbers are quite significant. So 2022, around 400,000 vehicles in China were EREVs. 2023, that was almost 700,000. So it's growing really significantly, and we are seeing models being released elsewhere in the world. So that's the sort of transition technology that could act to help the next cohort of consumers, give them the confidence to make the switch into a battery electric vehicle, but it also happens to contain an internal combustion engine and has fairly significant PGM demand requirements. So there's a lot of things that are ongoing there. I think ultimately we haven't changed our estimates as yet, but we're probably going to downgrade our battery electric vehicle market penetration growth rate going forwards, and the counterpart to that is going to be higher demand for vehicles that contain an exhaust treatment system of some form or another.
Wow. And I think I read in your research that the existing users of internal combustion engine vehicles are holding on to their cars for longer. That's, I guess, is withholding some of the scrap platinum away from the market. And obviously prices for platinum have been somewhat weaker, and that's also holding back a bit of scrap. Do you expect at some point this inventory to come into the market and increase the supply of scrap? And how meaningful would that be if it does arrive?
I think ultimately, yes. It's just a question of the time. So if we look at the numbers between 2021 and 2023, recycling supply for platinum fell by about 500,000 ounces. And that's because of the holding on to end-of-life vehicles for longer. It's because of, so there's a shortage of end-of-life vehicles. It's also because of some regulatory challenges in the US and in China in particular that are limiting the ability for the recyclers there to operate at full capacity. Our base case assumption, so we forecast out to 2028, is that over that time period, we see those the recycling rates recover back to normalized levels. And certainly at some point, I think, to your point there, we would expect some of that pent-up material to flow through. The challenge is we just don't know exactly when. And the other thing is that the reasons that the recycling fell by 500,000 ounces haven't actually yet gone away. So if anything, right now we think the risks are to the downside with recycling supply. So I think ultimately it will still recover. All of these things are solvable problems, but it's just the timing of solving them and when that supply growth comes through. So if you push that supply growth back, that kind of growth curve back at all, then obviously it deepens the platinum market deficits that we're expecting over the next few years. And for palladium, which is expected to go into a surplus on our numbers in 2025, those numbers are a bit stale now. But if we push back the palladium recycling growth, then palladium could remain in a deficit for a few years longer. And given there's an overall negative sentiment in palladium, it's incredibly short in the futures markets. That could have quite significant impact in terms of market dynamics.
Edward, commodity investors like this narrative of how emerging technologies can create long-term demand growth for certain commodities. And for platinum, of course, we know it's green hydrogen, both in terms of its production in electrolyzers as well as its use in hydrogen fuel cells, which creates a very promising new demand growth for platinum. How do you see the growth of green hydrogen evolving, and where do you think it's headed?
So I think we know what the destination is, but we don't know exactly what the journey is going to look like to get there. So if we look at subsidies available around the world from governments, they've gone from around $50 billion in 2022 to around over $300 billion today. So if I look at our longer term forecasts, we've got more than 900,000 ounces of hydrogen related demand for platinum in 2030. And that's out of a total market today of around 7.5 million ounces of demand. So, yeah, pretty significant percentage of demand in the future coming from hydrogen, which is fairly unique in the commodity world to have that sort of scale of new emergent end source of demand come through. The problem is that if we look at the near term, it's growing off a really, really small base. So currently in our numbers, I think we're around 100,000 ounces, maybe a little bit less than that for this year. So quite significant CAGR going forwards. But you've only got to have one or two plants delayed, and actually can have quite a significant, meaningful impact in near-term demand. So we know the destination, but the journey there is going to be a bit of a sore-edged one in terms of going up and down on a year-to-year basis. But certainly, it's if you look at the heavy-duty transportation industry as an example, it's pretty hard to electrify with battery technology. You're giving up a significant portion of your payload to the weight of the battery, and you've got to stop every however many hours to recharge for 6 hours. This just isn't particularly practical if you're doing long distance transportation. So for the high capacity utilization vehicle roles, and in sort of more remote locations and things like that, certain geographies, then fuel cell electric vehicles outcompete battery electric vehicles quite significantly, particularly with the subsidies that are available. So we see that as being the major driver of growth over the medium to longer term. Near term, electrolyzers are the big driver of platinum demand growth in the very near term.
Excellent. Very insightful, Edward. Thank you so much for sharing all of that. Nitesh, any closing remarks on platinum?
Well, I just want to echo Mobeen. Thank you so much, Edward, for joining us and giving some of your great insights into the platinum group metal world. And if any of our audience want to follow your research, please do remind them how they can access it again.
So it's all available on platinuminvestment.com, but also via a lot of the research platforms like Bloomberg and FactSet and so on.
Thank you so much. Take care.
Thank you.
Nitesh, we just spoke to Edward about one of the precious metals, platinum, but one metal that just keeps becoming more and more precious is gold these days. Tell us what is happening in gold markets.
Well, gold's extremely interesting. It hit an all-time high not too long ago. So 2 Fridays ago, it was at a record high on the back of elevated geopolitical risks. So not last Friday, but the Friday before, this was the day when Israel was preparing for an attack from Iran. And as that became known to the market, geopolitical risk was being heightened across the markets, and gold and oil and a few other commodities responded. And it's been something that's been baffling a lot of commentators and analysts looking at the gold market, because at the same time, U.S. Treasury yields and the U.S. dollar, Treasury yields have been rising, as in bond prices falling, and the dollar has been appreciating, which is normally something that weighs against gold. It seems to have been completely overridden by heightened geopolitical risk, but also elevated inflation. when we got the inflation numbers for the month of March confirmed in the middle of April, we found that inflation was running hot and is likely to remain that way. And that is something that's quite gold price supportive. Gold tends to do quite well in high inflation environments. So, according to our models, Wisdom Tree models, gold is actually trading well within its normal fundamentals, where its fundamentals are driven by bond yields and the dollar, which the two trends I've mentioned have been somewhat negative, but completely counterbalanced by higher inflation and a growing sentiment towards gold, driven by geopolitical risks.
So, Nitesh, you just mentioned your model, and many of our listeners must be familiar with your model and how it does a great job at explaining what drives gold prices. But I imagine it's a challenge to keep the model up to date when prices are moving so quickly. So what is your model telling us right now in terms of what lies ahead?
Yeah, so exactly as you say, the model in of itself doesn't come out with a forecast, but it provides a framework for putting gold in coming up with a gold price that's consistent with a view on the macro view of the world. So one thing I can do is if I take the consensus view on where rates will go, where the dollar will go, where inflation will go, and put that into my model. And I can get a consensus view maybe just by taking a survey from Bloomberg on economists. So if I take that, feed it into the model, where consensus has been, at least at the end of March, was expecting a continued decline in inflation, but remaining significantly above target rates, a decline in bond yields, and the dollar to soften a little bit. And if I combine that with a view on speculative positioning in gold futures markets, that is somewhat more conservative than where we are today. So today we're got net speculative positioning at 230,000 contracts net long. And if I more than half that to 100,000 contracts net long to be conservative, we get a gold price for Q1 2025 at 2,500. So it does indicate that there's still further upside towards gold prices today. We can play around with that model and think about alternative scenarios. If dollar were to depreciate faster, bond yields to fall faster, we would get a gold price of around 2,750. So there's still some pretty good upside potential. Obviously, scenarios can be played in any way, and we can think about downside scenarios where inflation falls and the dollar appreciates. That would drive a scenario where gold prices fall, but not by that much, to 2030 by that forecast horizon. Now, an increasingly likely scenario is that inflation remains stubbornly high and bond yields may increase even, from today's levels. And if that is because the Fed is holding off doing any rate cuts because inflation is high, that could lead to a bit of dollar appreciation as well. So in a scenario where inflation is high, but you get bond yields and dollar rising, we could trim gold prices to around 2,300 level. So it's not that much further downside from where we are today if we have that scenario where the Fed holds off.
On a very similar trajectory to gold is silver right now, Nitesh. Is there an equally bullish or perhaps an even more bullish story brewing for silver right now?
Yeah, so to put into context, we also have a model for silver, and that model recognizes that silver is highly correlated to gold. There's a close to an 80% correlation between the two metals. So if gold prices go up, then silver prices tend to go up as well. And that's exactly what we've been seeing in play in this in the last few months. Now, if we take that consensus scenario for gold and feed that into our silver model, the remaining 20% of gold, silver prices that aren't explained by gold are really driven by the fact that silver is much more of an industrial metal than gold. And so what we like to do is look at proxies for demand, which are driven mainly by industrial uses, and the supply of silver, which is largely driven by inventory that's already available, but also the potential for new mine supply to come on. Looking at the demand side, we use the purchasing managers indices as a proxy for the demand picture. And what we've seen is global manufacturing PMIs have actually increased over 50, which is the demarcation between expansion and contraction in the industrial world. And we expect that recovery to continue for the forthcoming year. Looking at capital expenditure in mining, we get a proxy for what is the likely path for more silver material to come out of the mining world. Now, what we do is take a lag on historic capital expenditure as a proxy here. Now, while capital expenditure has seemed to have rolled over, so capex growth is decelerating right now, because we apply a lag, an 18-month lag, that is looking at a window of time when capex was actually increasing in the mining world, we could see a little bit of headwind for more material coming out of the ground. But the strength in gold prices and that recovery in manufacturing override that. And we're expecting a silver price of $32 per ounce by the end of Q1 2025, which would outpace that growth that we talked about for gold.
So many investors, Nitesh, consider silver as an alternative way to express their views on gold, especially when gold is at record highs. So I suppose based on what you've described as per your model, that seems like a smart thing to do.
Yeah, absolutely. I think silver has different dynamics than gold. While there's a strong 80% correlation, its industrial uses are that much more wider. Gold is relatively expensive to use in industrial applications, even though it may be a great material for it. But silver, one of its key characteristics is its ability for conducting electricity. And with the increasing electrification of this world, electrification in vehicles, and electrification of applications as well, what we're finding is an increased amount of smarter technologies being deployed, especially with artificial intelligence becoming something that's being embedded into consumer electronics. There is an increasing demand for silver. One of the key growth areas for silver today, in fact, is its use in photovoltaics. So that's the solar panels, when that uses a lot of silver. For a number of years, we were seeing a little bit of thrifting going on in solar panels. So for each solar panel unit, there was less and less silver being applied into each unit, even though the volumes of solar panels were growing. But with the new solar power technologies that are being rolled out, they actually need higher units of silver applications per unit, which will reverse that sort of thrifting trend and like to see silver grow even further. So silver is in a supply deficit today, and we expect that deficit to continue into next year, and which will be very supportive for the metal. So Mobeen, we've talked a lot about precious metals so far, but if we look at the past month, one of the other strong areas in the commodity world has been energy complex, and oil prices have rebounded close to 10% over the past month, up until sort of last week, and then oil prices have cooled over a little bit. Tell us what's happening in the oil markets. What's driving such strong growth and maybe that little bit of pullback recently?
So, first thing with oil, the increase in prices since the start of this year, it certainly seems like it cannot be explained by the demand side of the picture. According to the International Energy Agency's latest April oil market report, oil demand growth was um, losing some momentum in the first quarter of this year. It was up 1.6 million barrels per day in Q1 2024, but this was below previous forecasts. So demand side of the picture cannot explain what's going on with oil prices. It's mainly a supply side story. First, it was the extension of voluntary cuts from OPEC Plus. And then, as you mentioned in the context of gold, Nitesh, the added geopolitical risk premium from the tensions in the Middle East. Now, Iran is, of course, a very important producer of oil, produces roughly 3 million barrels per day. This is around 3% of total world supply, so fairly significant. And there are three key risks here if you think about Iran and Iran's oil supply in the context of tensions. First, if of course Iran is involved in an outright war, some of that supply could simply be disrupted. Second, if there are more sanctions applied against Iran, that too can take some of that supply offline, even if there isn't an outright conflict, but there are sanctions imposed. And third, the Strait of Hormuz between Iran and Oman is a very important trade route. Roughly 20 million barrels per day of oil flow through that strait. This is somewhere between 20 and 30% of total world oil supply. And if that becomes a choke point, that too could become a big problem for the flow of oil. So, a number of different risks and different levels of risks associated with the conflict and the tensions in the region. But for now, oil futures curves are in backwardation, and backwardation being a state of the curve which where front month futures contracts are at a higher price than longer dated contracts. And this basically indicates tightness, near-term tightness in the commodity market. So oil curves being in backwardation suggests that markets are pricing in near-term tightness. But most likely, oil will remain in reactive mode and probably exhibit volatility depending on how things evolve on the geopolitical front. Would you concur with that, Nitesh?
Yeah, I think that's an excellent summary. I mean, the key thing to note about oil markets is the existence of the OPEC group, and with their partners, they control that close to 45% of the market. And as you mentioned, they've got the voluntary supply cuts, and that group can almost dictate the market balances um, through utilizing their spare capacity, widening their spare capacity, as in cutting back on production um, when prices and balances are weak, but also expanding it when conditions are tight. So, but the key risk is right now with Iran, representing close to 3 million barrel per day of production. If Iran were to come offline for any of the reasons that you outlined, that would use up a lot of the OPEC spare capacity. And the OPEC spare capacity can't be switched on overnight either. So that does provide that sort of upside risk to oil prices right now. Mobeen, the other area where we saw a lot more excitement coming into the commodity markets has been industrial metals. And that comes after quite a rough year in 2023. And even in the first quarter of this year, industrial metal prices were fairly moderate. But in the past month or so, we've started to see industrial metals prices coming to life. What's happening there? Is there a fundamental driver behind that?
So we've been saying, Nitesh, you and I on this podcast, certainly, and in all of our research materials, how industrial metals have perhaps been overly pessimistic, certainly through 2023 and, like you said, first quarter of 2024, and almost been pricing in a recessionary scenario for 2024. But what we're seeing in 2024 so far is a lot of resilience in economic data, certainly from the two biggest economies in the world, US and China. And for metals, of course, you can look at a whole range of economic indicators, but one of the most important ones that anyone looking at industrial metals is the Manufacturing Purchasing Managers Index, so PMI on the manufacturing side. And what does this indicator tell us? It tells us whether manufacturing activity is expanding month on month, or is it contracting in that economy. Fortunately for industrial metals, activity has been expanding in both the US and China this year, which is a very encouraging sign. Moreover, the International Monetary Fund, IMF, has recently come out with a fairly steady economic growth projection for the global economy for 2024 and 2025, predicting that growth rate will be about 3.2% in both years, which is the same as 2023. Now, that's not a bad thing at all if metals have been pricing in a recessionary outlook, and here, if you end up with a fairly decent growth rate rather than a recessionary scenario, so that all is improving sentiment. And then furthermore, additional impetus is coming from supply cuts. And recently, we've seen nickel mining operations being suspended in places like Australia. We've seen coordinated smelting restraint in places like China. So all of that is further supporting that positive sentiment on the demand side, with some supply constraints as well. So overall, if demand turns out to be higher than expected, we may see tightness in industrial metals because supply is being pulled back as well, and that of course should be price positive. And this is perhaps something that speculative futures markets are catching on to, because in recent weeks we have seen an increase in net speculative positioning across many industrial metals, which shows a very important switch in sentiment among investors. But on that point about switch in investor sentiment and a change for the positive, Nitesh, this is a theme that we've been talking about quite broadly, not just for industrial metals, but for commodities at large, for many different parts of the commodity spectrum. One particular commodity where this phenomenon has been true is European carbon. So European Union allowances, and uh, this is perhaps one where we could close on, Nitesh, this episode, because this is another one where spec positioning in recent times, in recent months rather, was perhaps excessively bearish, but lately it seems to have turned, and along with that turn has there has been a pickup in prices. And I must say that a few weeks ago you called it perfectly in a blog, which our audience can check out on our website. But tell us a bit more about how you see that situation in European carbon markets.
Yeah, so as you outlined, European Union allowances, they're basically a proxy on the carbon markets. They're used as a regulatory tool. For the European Union to meet its climate targets, it has caps on carbon emissions from certain sectors, and they release these things called allowances, which allow producers of goods and services to um, uh, pollute, but they have to surrender a European Union allowance. So they have to go into the market and buy one of these things and surrender it to the government at the end of their period, which ends up putting a price on carbon. Just to give a bit of context to the audience of what these things are, there's an active futures market on these allowances, and these allowances should really reflect the supply demand tightness and availability of allowances. By definition, every year this market should get tighter and tighter, because that's the whole idea of the policy dynamics, that you reduce the cap on emissions each year. And but the demand is always unknown, right? At any point in a year, um, We don't know exactly how much polluting activity will go, but it tends to be correlated with economic activity, right? The more economic activity that takes place, the more polluting activity that should also follow as well. So last year, these allowances had hit a record high of over €100 per ton. But this year, just over a month ago, we hit a low price of €60 per ton. Quite a significant decrease in price. Now, if you try to look at, how we can explain that, yes, okay, the European Union has been in a so-called industrial recession, but industrial activity has been improving. Yes, we've gone through a relatively mild winter, which reduces our demand for energy sources, and particularly the more polluting energy sources like coal or oil, which may reduce the amount of allowances that utilities have needed. But that correlation between the fall in energy prices and EUAs had got heightened to a new level, and that just didn't look right. So if we dig that a little bit deeper, what we saw was increased pessimism from the financial markets. If you look at net speculative positioning in EUA futures from the investor community, that had gone to record levels. And that really looked like the culprit. It looked like the market had gone excessively short. And it was ripe for a short covering rally. Just a small spark in terms of improved conditions could send that unwinding. And I believe we're starting to see that, really. So shorts are starting to come off a little bit. And that's driven close to a 30% increase in EUA prices over the last month. So I think that's really it. And nothing's really fundamentally changed. I mean, yes, economic resilience may have improved a little bit globally, but in the context of Europe, nothing has just changed massively. But it does look like that excessive shorts have rolled over. But I think with that, we have come to the end of our podcast today. And thank you, everyone, for tuning in. We do hope you've enjoyed this episode of the Commodity Exchange. If you do want to hear more from us, please do subscribe on whichever platform you're using. And please take a moment to leave us a 5-star rating. You can follow us on LinkedIn or X at Nitesh Shah WT and at Mobeen Tahir WT. And if you want to hear more about commodities, please do visit our website. That's Wisdom Tree's website, where you can find a range of research and material and insights. Until next time, thank you.